Hey everyone, and welcome back to the channel. If you're new here, make sure to hit that subscribe button and turn on notifications so you don't miss any of our financial insights, tips, and strategies. Today's topic is crucial, especially in times like these. We've all seen the headlines, heard the news, and felt the market volatility. Stocks dropping, interest rates rising, uncertainty all around. But have you ever wondered why the stock market reacts so strongly to risky behavior in the news? In the last few months, we've seen a significant dip in the market, and it's easy to panic when the news cycle is filled with negative headlines. Today, we're going to break down why the stock market hates risky behavior in the news, why investors panic during these times, and what you can do to stay calm, collected, and make smart financial decisions. Let's dive in. So, first things first, the stock market is driven by perception. Now, I know this might sound like a vague concept, but stick with me here. In the stock market, investors are constantly reacting to news and information. The moment a piece of news is released, whether it's about politics, the economy, or a corporate scandal, investors react. Those reactions are based on what they perceive the news means for the future, and that often leads to emotional decisions. Think of it like this. If there's a sudden headline about an economic recession, investors may assume that companies will perform poorly. That fear can trigger a sell off, where investors start dumping stocks to cut their losses. That in turn causes stock prices to fall. It's important to know that the market doesn't always react to what is actually happening, but rather to what people believe might happen in the future based on that news. This is what we call market sentiment, and it's often heavily influenced by the media. Now, let's talk specifically about risky behavior in the news. Over the past few months, we've seen headlines about interest rate hikes, geopolitical tensions, inflation fears, and even political instability, all of which send investors into panic mode. When these types of stories dominate the news cycle, they make the market nervous because they introduce a high level of uncertainty. And when the market is uncertain, risk becomes the primary concern. Risk means unpredictability, and investors don't like unpredictability because it makes it harder to plan and forecast future profits. The more risk the market perceives, the more likely investors are to sell stocks and shift into safer assets like bonds, gold, and even cash. For example, when the Federal Reserve announces an interest rate hike, it raises the cost of borrowing. Higher interest rates make it more expensive for businesses to take out loans, which means that profits may decrease. This type of news can cause investors to reassess the value of their holdings, leading to market pullbacks. Additionally, geopolitical risks like ongoing trade wars, political turmoil, or wars can create instability. Investors generally dislike uncertainty because it can disrupt supply chains, harm businesses, and lead to volatile stock prices. This is why you might see stock market dips every time there's a headline about a major global crisis. It's the uncertainty surrounding the situation, not necessarily the actual event, that causes the panic. Now, let's talk about something very real: fear and panic. The news cycle has a tendency to amplify these emotions, and when fear takes over, it can drive the market into an emotional state where prices move more on sentiment than on fundamentals. Here's an important point: fear isn't always based on rationality. When we see negative headlines like stocks tumble as recession fears mount or investors flee the market, we tend to feel that our investments are in jeopardy. This panic selling causes a self fulfilling prophecy, where the market continues to fall simply because people are scared. But here's the catch: fear driven selling doesn't always represent the true value of companies. Often, it's just a knee jerk reaction based on temporary news cycles. Over the long term, the market tends to bounce back, but during these moments of panic, it can be quite difficult to see that. For example, in 2020, during the early days of COVID-19 pandemic, the stock market crashed dramatically. Everyone was scared. Headlines were filled with uncertainty. But if you had stayed calm and held onto your investments, you would have seen the market rebound and hit new heights within that same year. This is why understanding market psychology is so important. While the news can create fear, history shows that the market often recovers over time. However, panic selling can hurt you, especially if you make emotional decisions based on what you see on the news. Now that we've discussed why the stock market reacts to risky news, let's talk about what you can do to protect yourself during the volatile times. Here are some strategies to keep in mind when the news is filled with fear and uncertainty. Number one, focus on the long term. It's easy to get caught up in short term noise, but remember that the stock market is a long term game. Over time, markets tend to rise, and even if there are dips along the way, historically they've recovered. If you're in it for the long haul, don't let short term volatility affect your decision making. Number two, diversify your portfolio. One of the best ways to protect yourself during times of market instability is by diversifying your investments. A well balanced portfolio that includes stocks, bonds, real estate, and even some cash can help cushion the blow when the market takes a hit. Diversification reduces the risk of putting all your eggs in one basket. Number three, don't panic sell. As tempting as it may be when you see your investments drop in value, resist the urge to panic sell. Remember, markets fluctuate, and what's happening right now might not reflect the true value of your investments. Instead of selling in a panic, think about whether the underlying businesses or assets you've invested in are still solid in the long run. Number four, keep your emotions in check. It's important to recognize that the stock market is emotional, and it's easy to get swept up in the fear. Take a step back, breathe, and evaluate your portfolio from a rational perspective. Avoid making decisions based solely on emotions or headlines. And number five, consider professional advice. If you're feeling overwhelmed by market volatility or uncertainty about how to navigate it, don't hesitate to consult a financial advisor. A professional can help guide you in creating a strategy that aligns with your goals and risk tolerance. To wrap things up, it's important to understand that while the stock market does react to risky behavior in the news, it doesn't always mean the market is doomed. The reality is that market fluctuations are normal, and news cycles will continue to amplify fear and uncertainty. But if you're a long term investor, you can protect yourself by staying calm, diversifying your portfolio, and focusing on the fundamentals. Remember, the market isn't always rational in the short term, but over the long run, it tends to reward patience and a steady approach. So, when the news is full of doom and gloom, don't let it dictate your financial decisions. Stay informed, stay calm, and stick to your long term strategy. Thanks again for watching, and if you found this video helpful, don't forget to like, comment, and share it with others who might be feeling anxious about the market right now. And of course, subscribe for more financial advice and tips on how to make smart investment decisions, even when the news is full of uncertainty. Until next time, thanks for watching.